Welcome to Pixalearn. We offer expert-led courses for CPA, EA, and other professional certifications to help you advance your career.
Talk about another business deduction, which is startup and organization cost. Now, one thing I want you to register here, which is that the US GAAP rules, so US GAAP and US tax rules are different for this expense. Which means what? If you look at the accounting is very clear. GAAP says expense everything. GAAP will not allow you to book anything and defer it in the future years. But tax has a separate rule. So what are the taxation rules for organization and startup costs? What is a startup cost? So the first question is, how do you differentiate between the two costs? Before you understand the rules, it's important to know which of the cost given would be a startup cost and which of the cost would be organizational cost. Now, startup cost is anything that helps you to propel the business and bring it into place in the first place, right? So we're not talking about the cost of organizing a business. So when you say I'm organizing a business, we are actually talking about employing a lawyer, filing the paperwork, drafting the charter, let's say filing the memorandum of association, the articles of association, appointing the temporary directors, incorporation fees. So if you're setting up a sole proprietorship or let's say a partnership in a particular state of Delaware, let's say, then there would be a charge that you will have to pay for that. Again, there would be some filing fee. So all of this is a one-time expense that a business incurs for organizing itself, and we call them organization costs. Startup would be a one-time cost. For example, let's say I'm starting with a dealership. And so let's say if you know MG Hector is a car company which opened in India recently, a couple of maybe around 6-7 years back. So when you are organizing your business for the first time, and then when you are starting up, you get a good funding because you have a superb idea. And then what you do, you have a great advertisements that you just launch the product with. So that's a one-time expense, and we call it startup expense. You could also have surveys, market research, training of individuals at that point of time, having consultants to organize your business. Please remember, all of these would be startup costs, and these are two separate things. So the first thing you need to do is just bundle up the cost under two heads, which is the startup cost, which is the OR cost. In my opinion, it's very easy to understand an OR cost. To undertake an OR cost, anything else would become a startup cost. The only two things you'll have to understand is, first, don't include any capital expenditures. So if you are building up an asset, so let's say you're buying a particular building as an office space. Okay, so you're buying up an office, and for that you're renovating it. Now that's actually a capex expenditure, and you're not going to call it a startup expenditure. Also, no inventory. Okay, if you're buying goods to sell, and first time when you're starting your business, you're buying a lot of those inventory in order to sell. So let's just say, for example, I'm starting up a gaming business. I'm opening a new center, a new outlet in a mall for selling up my PS4s or PS5s as we call it. Now in that case, the initial stock that I get in order to sell it, that's still inventory that cannot be characterized as a startup cost. So remember, no inventory, no capex expenditures. Anything else, first understand what is an org cost, which is easy to understand. If it is not org, then it becomes a startup cost. Now, what does the rule say? So it's very important to know what is included and what is not included. So this exception is important. In the startup, we are not going to include any kind of a research and experimental costs. We are not going to include interest, taxes, or any such items. In the org cost, we are not going to include the cost of raising the capital. So if I'm coming up with a bond issue and there's a cost involved therein, we are not going to call it an org cost, because that's going to be we are going to club it in the amortization of discount or premium for the bonds. Similarly, if I'm issuing shares and if there's a common stock issue amount of expenditures involved, I'm going to reduce it from my APIC. In other words, share premium account, additional paid in capital account. In other words, we're talking about startup and org. We're not talking about raising money. We're not talking about buying inventory. We're not talking about buying assets. So remember, not raising money. Okay, not buying assets, not buying inventory. So these are three very big items which they confuse you with when you're talking about the startup and org costs. Okay, now first it's very important that these costs have to be incurred before the tax year ends for a corporation, or when the first return is due, which is partnership. So typically these are the figures that have been incurred before the business came into existence and came up and filed their first income tax return. What is the tax treatment? Now this is important, guys. Okay, what is the tax treatment? So we are saying that, see, it's ideally in the US there are certain themes that runs throughout, right? We want you to open startups, we want you to invest in education, we want you to invest in retirement funds, and we want you to be married and remain married, right? So we give you a tax incentive for doing so in order to give a boost to startup community. See, you look at accounting rules. Accounting says put everything in the P&L account. So put everything in the income statement and expense it in the same year. Tax says no, I'm not going to allow you to take that much amount because I don't know, you may be spending some $30,000. You don't want me to put all of that in the first year itself because your business hasn't even started. But what I can do for you is, in the first year when the business is starting, I can give you a head up and I could tell you that take $5,000. So that according to me is a big amount. And I let you take that $5,000 in bulk. But please remember, $5,000 each for startup and each for the org cost, but only in the year in which the business begins. So what we're saying is accumulate all your costs under two headings, startup and organization separately. Now for each of these, for startup and for org, I'm going to let you take a deduction of $5,000 in the first year itself when the business begins. So you get a total of $10,000 in the first year itself. Any excess that you have, so let's say you've spent $15,000 for startup and $20,000 for org cost. So for each of them, I'm going to let you deduct $5,000 in the first year itself. Now for startup, I have $10,000 remaining, and for org, I have $15,000 remaining. So for each of them, whatever is the excess beyond this $5,000 that I have given you, I'm going to let you amortize over at least 180 months. So it could be more than 180 months. That means basically it can be more than 5 years, but it can be more than 15 years. But it has to be minimum 15 years. So please remember, it can be more than 15 years, I don't mind. But it has to be at least 15 years, which is 15 into 12, that is 180 months. And you need to start it with the month in which active trade or business begins. So what we're saying, pull up the cost separately, startup separately, org separately. Then what do? Take 5,000 in the first year itself when the business begins. Find out the balance and divide it by 180 and start it from the month in which active trade or business begins. That means in the first year itself, you take 5,000 plus the amount per month into the number of months starting from the month in which business began. We're going to give you questions on this, so this becomes really easy. But there is a caveat. See, this is a tax incentive that I'm giving to you because I really want you to start your business. But there is a problem. The problem is, what if you're really heavily funded? I don't think then you need this tax ESOP of, one time 5,000 is not going to make any difference for you, right? So what we say is, phase out is there. That means now this is a concept that I'm going to deal with much better when we're going to talk about IRA. But what I'm trying to tell you is, if I feel that you really don't need this, I'm not going to give this one time 5,000 to you. See, remember, divided by 180, that means whatever is the amount, you don't put it into P&L or income statement immediately. You put it into the income statement in tax for the next 15 years, at least 15 years. Could be 20, 25, 30, I don't have a problem, but at least 15 years. But remember, the moment your amount increases $50,000, individual amount, startup amount and org amount, individually, the moment it exceeds $50,000, I'm going to reduce that one-time leeway of 5,000. So that means what? Let's say I'm going to give you, you have 5,000, you have 10,000. So I'm just taking one of those expenses, okay? So let's say startup cost. You had, so this is first scenario. You had 5,000, you had 10,000, you have 45,000, you have 50,000, you have 55,000, and you have 70,000. Okay, these are different scenarios. So what I'll tell you, till 5,000 you can get full amount and you have nothing left for the balance 180. Till 10,000, I will let you take 5,000. Plus, let's assume you started your business in the midway. Let's say you started your business in the month of July. So for 6 months, so 5,000 is left, you take 5,000 balance which is left divided by 180 months, and for 6 more months which are applicable for this year, I'm going to let you take the excess. For 45,000 and for 50,000, the same rule applies. I take 5,000 in the first year itself, whatever is the balance divided by 180 into the number of months starting from the month in which active trade and business began. Now, if that amount is 52,000, what will I do? That amount is 52,000. I know it is 2,000 more than 50,000. So what will I do? This 5,000 will be reduced by 2,000. I'm going to get 3,000 only. So I'm going to get 3,000, and then you have this balance. 52 minus 3 is 49,000. I will take 49 divided by 180 into the number of months. The moment it exceeds 55, this one time becomes 0. So just imagine if it is 70,000. My one time becomes 0. The entire 70,000, I'll have to divide it by 180 and then multiply it with the number of months in which active trade and business began till 31st December. That would be the number that's applicable. We are going to take a couple of questions to understand these rules properly, but please remember, bulk it in 2 different headings, add them up separately, and then you get maximum 5,000 one-time deduction provided your total amount is less than $50,000. The moment it is in the bracket of 50 to 55, that 5,000 will start reducing to 0, and then the moment 55,000 is crossed, you don't get any one-time deduction. You will get only the total amount divided by 180, which is at least 15 years, into the number of months starting from the month in which active trade and business began till 31st December of that year. That's the rule. Let's take certain questions in order to discuss more on this. Now see what I try. Okay, these are finer stuff. We'll go to it later. Let us first understand the full rule, and then we're going to go to some minor details that you need to bear in mind. The first question is, what is the maximum deduction that the company can claim for organizational expenses on its year 2 federal corporate income tax return? Apex Logistics Corporation began active business operations on October 1, year 1. That means how many months? October, November, December, 3 months. I'm going to get these expenses for 3 months, and has elected to amortize its qualifying organization expenditures of 90,000. Now, is this amount till 55,000? The answer is no. So what is the rule saying? I'll get you one time plus I'll give you monthly amortizations, right? Monthly amortization. So one time is possible only if your total is less than. So one time is how much? Maximum is 5,000. And every time when your total expense exceeds 50,000, this 5,000 starts reducing. So if it is 51,000, you will get 4,000 one-time reduction. 52,000, 3,000. 53,000, you get only 2,000 as a one-time expense. 54,000, you get only 1,000 as a one-time expense. 55,000, you get 0 as a one-time deduction. This amount is more than $55,000. That means the one time has been completely phased off. You get nothing in the one-time deduction. What is a monthly amortization? You take 90,000, divided it by 180. Whatever is the figure, which I think it's $500. $500 per month is the amount starting from 1st of October, year 1. So ideally in year 1, you will have certain numbers, which is into 500, which is 1,500. But then the call of the question is not year 1. The call of the question is year 2. So how much is the deduction that you will get in year 2? It is 500 into 12 months that you get for year 2, making it a total deduction of $6,000, which is answer 3. So the answer to the question for startup and or cost becomes C for Calcutta, Cuttack, or any such numbers that you take. So what do? Or cost exceeds 55,000, one time becomes 0, and After that, you just need to amortize it over at least 15 years, which is 180 months. Here they're talking about the next year after the initial year. So you get full 12 months amortization. Hence, the answer is C. Now look at the next question. Here we have the startup costs. What is the maximum deduction the taxpayer can claim on his federal tax return for the current year, including any immediate expensing allowed, rounded to the nearest dollar? Marcus is a former software engineer who decided to manufacture and sell his own brand of ergonomic computer keyboards. He incurred the following expenses during the current year before beginning operations. So they're saying what is the maximum deduction? They're not talking about anything else. Market and feasibility research. So I know that this is startup, right? And then we have an org cost. So this is startup. Circuit boards and plastic casing raw materials. So I know not inventory. I know not capex. Setting up a preliminary bookkeeping system. Even this is going to be startup. Legal fees to secure a 5-year commercial building lease. So I know even this will not be allowed. Why? Because this is capital. So this is inventory. And ideally, the cost of getting into a lease will also be capitalized to the lease cost. So even this will not be start-up cost. So what do we get? We get $4,800. Awesome. $4,800 is less than $5,000. So in the initial year itself, you get the entire $4,800. Is the answer D? Think properly. What's the call of the question? Are they asking you how much of the startup cost you will get? Or are they asking you how much of the total expense can you get in the first year itself? See, the call of the question is what is the maximum deduction Marcus can claim on his federal tax return for the current year, including any immediate expensing allowed. That means this lease is also going to be written off over a 5-year period, right? And when is the business starting? November 1. So we have 2 months, November and December. We have 2 months for which you're going to write off the lease cost also. So if you look at it, we have 3,000, which we will have to divide by 60 in order to get me the writing off of the lease cost every month till the expiry of the lease, which is 12 months for 5 years, which is 60 months. So if you look at it, so if you look at it, $50 per month becomes my lease absorption, so amortization expense on the ROU asset. So I take 50 here, 50 here. So the amortization cost for the lease becomes $100. My startup expensing, which includes immediate expensing, is $4,800 expense. So I add 4,800 and 100, and the total amount of deduction that I can claim in the current year becomes $4,900. The answer is C, C for Calcutta. Now please remember guys, it's not enough to know the provision well. In fact, in the EA exams, any US based exams, one is knowledge and the other is trap. And the traps you can understand. So I call these traps, okay? You know the answer. You know 4,800 is the answer, and the thing that we're studying is startup cost. But the call of the question is what is the total deduction that you can take in the current year? Not specifically the deduction for startup costs. So the answer becomes 4,900 because of all the data given to you. We have 2 expense that you can take, the startup expense and the amortization of the lease expense. So startup, it's less than 5,000. You take the full amount. Amortization, you get only $100 because it's November and December. So the answer becomes C. Okay, so actually this is a very good question, guys. Okay, if you look at it, I'm going to call it a very, very good question. Now we have a question where we have a mix of both. We have startup costs also, and we have org costs also. And you need to apply the rules. If you can do this question properly, frankly, you've been able to understand everything, okay? Look at this question. If the corporation elects to amortize its org and startup expenditures over the minimum 180-month period, which is 15 years, what is the maximum amortization expense it can deduct on its year 2 federal corporate income tax return. So they're actually talking about the amortization of these startup and org costs. Now, one thing I want you to understand is there's a difference between the term amortization versus depreciation. Now, see, depreciation is a term that most of us must be aware of, right? Depreciation is for tangible assets like plant, machinery, furniture, fittings, computers, all of this we depreciate. Technically, for US accounting and US taxation, the term that you use to write off intangible assets in your books or intangible expenses in your books is actually amortization. So this is actually a one-time cost that you don't want to put into your income statement immediately. That's the reason we amortize these costs. So let's take step 1. So what was step 1? Step 1 was simple. Please accumulate your startup separately and your org cost separately. So during October and November of year 1, the corporation incurred 80,000 in market research. I know 80,000 is startup expense. 96,000 in legal fees to draft a corporate charter and bylaws. And I know this is an org cost, right? 25,000 in pre-opening promotional advertisement. So I know that this is also a startup cost. And 35,000 to purchase manufacturing machinery. Now see, this is a direct machinery purchase cost. And they're specifically talking about amortization. So I know that we're not even going to take the depreciation of this in this year because they're just talking to me about the amortization of startup and org costs. The company officially began active business operations on 1st of January year 2. So they began their business on 1st of January year 2. If the corporation elects to amortize its org and startup expenditures over the minimum, what is the max? So my year of starting the business is 1st Jan year 2. So ideally I should be getting whatever deduction I get, I should be getting it for 12 months because the month in which active trade and business began is in January. Had this date been 38th January, 30th, 28th, 25th, even then the answer would have remained the same because you take the full month in which the business started. So what do? I add it up. I have total 105,000. Sorry. So this is, okay guys, I'm not 105,000 in the first year for the startup cost and 96,000 in the org cost. Now the moment I see these expenditures, right, immediately my brain tells me they are incurring too much. Why? Because this is way above 50,000 plus 5, right? So 55, it has crossed that threshold. So one-time expense, since both of these costs are more than 55,000, you will not get any one-time expense in either of these two scenarios. So what are you going to do? You're only going to talk about monthly amortization. And what is the monthly amortization that we're talking about here? Okay, we'll divide each by 180 months. And then whatever is the figure that you get, you're going to multiply it by 12 in order to tell you what is the maximum amount that you can take for this year. Okay, so let's just calculate this. So it is 105,000 divided by 180 into 12. So this gives you 7,000 for startup costs. And how much is for the org cost? For the org cost, you'll have 96,000 by 180 into 12, which makes it $6,400. So I'll add both of them. So I have 7,000 plus 6,400, which makes it 13,400. So this is the amount that you're going to get as a deduction for this particular year. So the answer becomes C for Calcutta. Is this clear? So what we're doing, startup, org, one-time expense only till 5,000, and that also you're going to phase it off the moment the total expense exceeds $50,000. So from 50 to 55, you will get reduced figures. After 55, you will not get any one-time expense. Then you just need to take the balance, divide it by 180, and then find out the number of months from the month in which active trade and business began till 31st of December. Whatever is the number of months multiplied by your monthly amortization you get the total startup and all costs that you will be entitled to take the deduction for in the current year. Okay, last question before we just go through those extra 1 or 2 topics or extra points that we left earlier. What is the company's taxable income for the current year ended 31st of December? The company's book income, so when you say book income, I'm talking about GAAP or accounting. Now, one thing I'm going to tell you guys is that, see, this is just the beginning. This is part 1. It is important that you have some basics of accounting, because even when you go later and you start working, or if you're working already, you will see a lot of taxation would also have a basis in accounting, at least for corporate taxation. When you go to part 2, that understanding has to be clear, because you're going to take accounting income and then convert it into taxable income. So even now, if you feel that, just the basic entries, if you're able to cull out, it will be really good. So the GAAP income, the accounting income before federal income taxes. So I start my GAAP income with $750,000. The company organized 4 years ago, so this company is not a new company. Total qualifying organization cost of $450,000 are being written off over a 10-year period for financial statement purposes. So what we did in GAAP, we divided it over 10 years, straight line amortization, and you're going to get 75. Okay, sorry. So you had $450,000. So $450,000, you divided it by 10, and that is the figure you would have depreciated or you would have amortized for GAAP. Now, please remember, this is a theoretical question, because nowadays in GAAP, you're not allowed to amortize anything. So ideally, you would have written off full 450 in the first year itself. But theoretically, if I have to answer this question, GAAP allowed. So basically, this income is after deducting $45,000 according to the GAAP laws. That means if I add back $45,000 and if I reduce the amount that is applicable for tax, I should be able to arrive at the taxable income. Isn't it, guys? So what should be the amount? According to tax laws, 450,000. Now this is way above 55,000, right? So no one-time deduction. I'll amortize it for 180 into 12. So basically I can divide it by 15 straight away. So this becomes $30,000. So I should have deducted only $30,000 according to the tax laws, but according to GAAP, it became $45,000. So what I did, I added back my GAAP income to bring to the situation where this difference can be avoided, and then I just reduce the taxable amount. So essentially, I add back 15,000 to the GAAP because of the tax and GAAP rules difference on account of org cost. So my answer becomes B for Bangalore. So the answer becomes B for Bangalore. Okay. Now just look at a couple of observations here. If you're having a startup and if that business, so you already have a business. So I'm already into 3 businesses and I'm launching the 4th as an extension of the current businesses. Then any startup expenses will be allowed as a deduction, even if the new business explode is not entered into. So I got into the mode of starting my business. I paid for the org cost, but then I ultimately shelved that business. The idea is I already have a gross income coming from my other 3 businesses. Now, if that be the case, then I'm not going to disallow you the org cost or the startup cost deduction just because the business could not stand up on its own feet. Why? Because I already have a source of income that you're offering and you can reduce it from there. But if this is the first business that you're starting and there is no income being generated from my business, and neither is there any scope of income being generated. Why? Because you've not even started this business. This was the first business that you would have started. You incurred certain expenses and then you just shut it off. However, for taxpayers who do not have any existing businesses, the startup cost deduction is not allowed if the business is not entered into. So think about it in the COVID era, guys, right? Imagine if I wanted to get into the hospitality sector. I wanted to open up a restaurant of my own. I did all the paperwork. I opened the restaurant. I designed my menu. I hired people. And then COVID hit. And I realized that this is not going to work. And I just did not launch my business. And all of that was a one-time expense which was lost. Do I get any tax deduction for that? The answer is no. Why? Because you did not even offer anything for taxation. So nothing doing. No deduction if it was your first business and it did not launch. Please remember, now this is important, guys, okay? Because when you see smaller examples where they kind of twist and tweak this particular provision, you should not miss this. The period of amortization must not be less than 180. What we're talking about is at least 180. We're not saying at most, please remember, which means the amortization period could be more than 180 months. That means it could be more than 15 years. The only thing is it cannot be less than 15 years. Okay, so just remember that. The rules are crystal clear. Take startup and org separately. Understand, no, you should not include the cost of raising capital, cost of putting an inventory or buying an inventory, and cost of capitalization. Then for the startup year, you can get 5,000 bulk in each. For all the subsequent years, you can get an amortization of whatever is the balance left divided by 180 months. And for this year, take the month in which active trade and business began till the close of the financial year, and that is going to be the amortization expense. Please remember, this one-time 5,000 will be disallowed the moment your total business, the total startup or cost separately, each individual of them exceeds $50,000. That means if actually from 50 to 55, you're going to phase off this one-time expense reduction of 5,000, and beyond 55, we will not allow you any expense. That's it. We're done with startup and all costs. Thank you.